Wall Street banks are currently staring down a $72 billion problem, a ticking time bomb of xloans that could reshape the entire credit market in 2026. This isn't just a hypothetical scenario, it's a quiet crisis brewing within the balance sheets of some of the biggest financial institutions. Think back to 2008, when overlooked mortgage-backed securities blew up the global financial system. Well, certain analysts are seeing echoes of that same kind of systemic risk today, but from a different type of loan. The core question here is: how did banks accumulate so much exposure to these specific loans, and what happens when they inevitably start to sour? We're going to dissect the anatomy of this problem, look at the key players involved, and track the historical parallels. And stick with me, because the last part of this is the piece almost everyone gets wrong about these situations, and it's the part that decides whether you avoid the fallout or get caught in the blast. Big banks are facing a ticking time bomb. JP Morgan, Bank of America, Wells Fargo, and Citigroup are currently holding a combined $72 billion in what we call xloans that are set to mature in 2026. This isn't just about big numbers, it's about a specific type of debt that carries unique risks for both the banks and the wider economy. To put that $72 billion into perspective, it's roughly the same size as the entire market cap of FedEx. These aren't your typical home mortgages or credit card balances. These are loans that were issued during a period of ultra-low interest rates and aggressive lending, and now, as the Federal Reserve has pushed rates higher, the cost to refinance them has skyrocketed. We're talking about a potential shockwave that could ripple through the credit markets, impacting everything from small businesses to major corporations. Consider this. During the 2008 Great Financial Crisis, a different type of loan, subprime mortgages, became the epicenter. While xloans are distinct, the underlying mechanism of widespread, hard-to-refinance debt in a rising rate environment carries echoes of past crises. The lesson here is that understanding the specific dynamics of these loans is crucial for anyone navigating today's financial landscape. Even more surprising than the sheer size of this debt is the fact that many of these loans were originally considered safe, even desirable, for the banks. We're talking about commercial real estate loans, or CRE loans, which are fundamentally different from your average home mortgage. These aren't loans on houses, they're on office buildings, retail centers, and multifamily complexes, mostly originated between 2012 and 2015. The structure of these loans is key to understanding the current predicament. Typically, they had fixed, low interest rates, often around 4 to 5%, with terms ranging from 10 to 15 years. The real kicker, though, is what's called a balloon payment, a massive principal payment due all at once at the very end of the loan term. For example, if a developer took out a $100 million loan in 2014, they might have made interest-only payments, or very small principal payments, for a decade, only to owe $80 million or more in 2024 or 2026. This setup made them incredibly attractive back then because property values were steadily climbing, and interest rates, guided by Janet Yellen and the Federal Reserve, were near historic lows, often below 1% for the Fed funds rate. Banks saw stable income from these fixed rates, and the property was considered solid collateral. For instance, a Class A office building in Manhattan bought in 2013 might have been valued at $500 per square foot. Fast forward to today, and that same building faces a very different reality. The lesson here is that even seemingly stable assets can become volatile when external conditions shift dramatically. What happens when those balloon payments come due, and the market has changed entirely? That's the $72 billion question. But here's the kicker. Many of these safe loans were originated when interest rates were practically at rock bottom. Between 2015 and 2021, the Federal Reserve kept the federal funds rate near a historic low of 0.25%. Borrowers, from major developers to smaller investors, flocked to banks like Wells Fargo, securing loans at incredibly attractive terms. Imagine a developer in Dallas, Texas, taking out a $50 million loan for a new office complex at 3% interest, with an impressive 80% loan-to-value ratio. That felt like a smart move back then. Fast forward to today. Jerome Powell and the Federal Reserve have hiked rates dramatically, with the federal funds rate now sitting at 5.5%. What this means for someone with a commercial real estate loan is that refinancing, which many of these loans will need to do in 2026, becomes exponentially more expensive. A borrower looking to refinance that same $50 million loan today isn't looking at 3% anymore, they're looking at potentially 7% or 8%. That dramatically changes their monthly payments and their project's profitability. The challenge doesn't stop there. The rise of hybrid work models, accelerated by the 2020 COVID crash, has left office buildings with significantly higher vacancy rates. In places like San Francisco, office vacancy rates soared past 30% in 2023. Lower occupancy means less rental income, which directly impacts the property's valuation. So, not only is the cost of new debt higher, but the underlying collateral, the property itself, is worth less. This creates what some are calling a debt death spiral. Lower property values mean banks can't lend as much against the property, even if they wanted to, squeezing the borrower from both ends. The lesson here is that what was once a sweet deal for both banks and borrowers quickly turned sour when the macroeconomic environment shifted. But if these properties are losing value and borrowers can't refinance, why aren't banks just foreclosing and selling them off? But here's the truly surprising part. Banks are trapped, and foreclosing on these properties isn't just difficult, it's actively detrimental for them right now. For the banks holding these $72 billion in maturing CRE loans, the choice isn't straightforward. They're essentially facing a dilemma. Either extend the loan, often called evergreening, or seize a devalued asset in a struggling market. Take, for example, a bank that lent $50 million on an office tower in downtown San Francisco in 2020. Today, that building's market value might have plummeted by 30% or more, due to remote work emptying out cubicles. The last thing JP Morgan or Bank of America wants to do is become an accidental landlord, managing an empty office building that's bleeding money. Foreclosing on a non-performing loan doesn't magically make the problem disappear, it just changes the problem. If a bank forecloses, they suddenly own a hard-to-sell asset. Worse still, regulators like the Federal Reserve require banks to hold more capital against these non-performing assets, which directly impacts their profitability and ability to lend in other areas. It's a double whammy. A lower value asset and higher capital requirements. This is why many banks are opting for an extend and pretend strategy, hoping that a market recovery will eventually bail them out. They're effectively pushing the problem further down the road, rescheduling payments or extending loan terms, even if the underlying property value remains depressed. This strategy, while delaying the inevitable, avoids the immediate pain of recognizing losses and the regulatory scrutiny that comes with it. However, if a cascade of banks were to start foreclosing simultaneously, it could trigger a deeper collapse in CRE values, creating a dangerous domino effect across the entire sector. What's not immediately obvious, though, is how even with these measures, the full extent of this pressure might still be hidden from plain sight. What if I told you the $72 billion figure we've been discussing might just be the tip of the iceberg, and bank regulations aren't even showing us the full picture? The truth is, current regulatory filings, like the Q3 2023 reports we see from major financial institutions, might not fully reflect the true scale of this ticking time bomb. Banks have a powerful incentive to kick the can down the road and mask the extent of these problems. Think about it. If they publicly acknowledge a massive amount of non-performing loans, it would immediately raise red flags with investors and rating agencies. For example, imagine a regional bank like Zions Bank Corporation, which had significant CRE exposure reported in their Q3 2023 filings. If they were to fully mark down all their devalued office building loans to current market prices, their capital ratios could take a serious hit. This is why many analysts believe banks are using various accounting maneuvers, like loan extensions or restructurings, to avoid classifying these loans as truly distressed. It buys them time, but doesn't solve the underlying problem. This strategy becomes even more complicated with the upcoming Basel III endgame capital requirements. These new rules, expected to fully roll out by 2028, will force banks to hold more capital against riskier assets. This means that eventually, banks will have to recognize these losses and set aside more capital, which could severely impact their profitability and ability to lend. The $72 billion we're tracking is just a fraction of the total commercial real estate exposure, with the broader market facing a staggering $2.2 trillion in maturities by 2027. The lesson here is that while current reporting might look stable, the underlying pressure is building. The true risk is that when rating agencies like Moody's or S&P eventually catch on and downgrade banks, it could trigger a wider crisis. But what happens if Wall Street's solution to this impending doom actually makes things even worse in 2026? But what if the solution Wall Street is banking on is actually worse than the problem itself? The most likely fix for these distressed commercial real estate loans isn't foreclosure, it's quietly extending them, but at significantly higher interest rates and often with accelerated payment schedules. For example, a loan originated in 2018 at a 3.5% interest rate might now be extended at 7.5% or even 8% in today's environment. This strategy, while avoiding an immediate hit to bank balance sheets, effectively creates what many economists are calling zombie loans. Consider a retail complex in Atlanta, Georgia, whose initial loan was taken out in 2017 when the Fed funds rate was below 1%. If that loan is now extended at current market rates, the property owner's annual interest payments could easily double, or even triple. Even if the property is technically performing, meaning the owner is making payments, the significantly higher debt service often drains all available cash flow. This leaves no money for essential upgrades, tenant improvements, or even basic maintenance. The lesson here is that an extended loan isn't necessarily a healthy loan if the underlying business can't sustain the new payment structure. This extended debt creates a massive roadblock for the entire commercial real estate sector. With properties saddled with unsustainable debt, there's no incentive for new investment, no capital for development, and ultimately, no job creation in an industry that employs millions. As Jerome Powell himself noted in a 2023 press conference, the CRE sector is facing significant strains. If this stagnation persists, especially for the $2.7 trillion in commercial real estate loans maturing by 2027, the long-term systemic risk grows. This is especially true for regional banks, which often have a much higher concentration of their portfolios in commercial real estate compared to the Wall Street giants. These zombie loans could very well be the hidden lever that pulls down more than just a few struggling properties. So, while it's tempting to draw parallels to 2008, the crucial difference here is not a sudden implosion, but a slow, persistent economic drain. Unlike the rapid cascading failures of the global financial crisis, where subprime mortgages instantly contaminated the banking system, the $72 billion xloan problem is more like a persistent low-grade fever for the economy. It means slower growth, a sustained drag on local economies as commercial projects stall, and a ripple effect into related sectors, potentially causing job losses in construction, property management, and even retail. The lesson here is that financial distress doesn't always arrive in a crash, sometimes it's a slow burn that quietly impacts investment returns and everyday livelihoods. Have you seen commercial properties in your own city sitting vacant, or development projects suddenly grind to a halt? Share your observations and location in the comments below. I'm curious to see how widespread this is. And if you want to understand more of these hidden financial currents that impact your money, hit that subscribe button to get data-driven insights every week. Next, you'll want to watch my breakdown of why the Fed's interest rate policy isn't impacting inflation as expected. It's a direct link to why these xloans are such a problem.